How to calculate rental yield. When buying an investment property, investors review the performance of their asset in three ways. These are income, capital growth, and tax effectiveness. Understanding the rental yield is among the most important factor when considering a purchase. In this podcast, we discuss what a rental yield is and how to calculate it and what is deemed a good return. First up, what is a rental yield? A rental yield is the annual rental income received or forecast to receive as a percentage of the total value of the property. A good rental yield determines the rental income you'll receive. The rental income is often important as the income can be used to service the loan, if a loan was needed to buy the property, provide an income stream in retirement, if you're debt-free, and can hedge your overall investment return. If the property hasn't witnessed capital growth over shorter periods of time, investors can still enjoy an income return through rent. Rental yield versus capital growth. When buying an investment property, investors want to see a combination of income and growth. Rental yield is not the only factor that determines whether a property is a good investment. Considering the prospect of capital growth is always desired, as you may plan to sell it in the future to receive a profit. However, capital growth is not a regular or consistent return. Successful property investors will aim to capture a combination of income and growth to stabilize their overall investment returns. How do we calculate or work out the rental yield? Calculating the rental yield of a property is far more simple than you realize. The formula is basically the annual income divided by the property value. When using this in a formula, if a property was generating a $450 per week rental return and the property was worth $600,000, what we do is we multiply 450 by 52 weeks to annualize that income. That would then generate a $23,400 rental return. If we divide that by the $600,000 property value, essentially that will give you a 3.9% return. What if I have an investment loan? If you want to identify your rental yield with an investment loan, then you simply reduce the annual loan payments from the annual rental income. Most investors only take into account the loan interest expense and ignore the principal part of the loan repayment. Taking the previous example, if the rent's $450 a week and the loan repayments were $300 a week, then the net rental income would be $150 per week. To annualize the rental income of $150 a week, multiply this figure by 52 weeks. This equates to $7,800 per year. Using the same formula as mentioned before, this would generate a 1.3% return. What is a good rental yield? Rental yields perform differently with each property type. Commercial property has a higher rental to residential, but the capital growth is generally lower. In regards to residential property, investments providing a rental yield of above 4% is seen as a very good return. The three main property types in residential property are apartments, standalone houses, or townhouses and units. Apartments generally generate the highest, followed by townhouses and then homes or standalone houses. The more expensive a property, the harder it is to continue to increase the rent to match the capital growth. Houses and townhouses receive a rental yield of more likely 3 to 4% to be satisfactory. When looking into rental returns, the cash flow of a property, you should always consider other expenses such as council rates, property management fees, owner corporation costs, if any, and water rates, just to name a few. You may want to reduce these costs from your gross rental yield along with the loan payments to get a more accurate figure on cash flow. This will allow you to ascertain if you need to cover any ongoing cost from your own cash flow or not. How do I work out the weekly rent? When calculating the rental yield, you'll first need to work out the weekly rent. Some of this can be figured out monitoring leases online, but we recommend speaking with a property manager who can provide a rental appraisal. Does the rental yield take into account vacancies? In short, no. When buying a property, there is a trade-off between renting a property at market prices or pushing an above average return. If you can't find a renter or you lose them, you can always potentially encounter a vacancy. When investing in property, you should always retain a cash buffer to cover any uncertainties, such as paying a month's loan repayment. If you'd like some assistance in calculating your gross or net rental yields, please feel free to contact us. We would welcome the opportunity to help. Our primary service at Crest Property Investments is to help source and find properties for buyers, either brand new or off the plan. If you want to learn more about us, feel free to visit our website at www.crestproperty.net.au. Thanks for listening.